Welcome to the Deep Dive, where we sift through stacks of information, earnings calls, research papers, all that stuff to pull out the key insights for you. Today, we're plunging into the Q2 2025 earnings call from Reliance Global Group. That's RELI. They're a microcap insurtech company, definitely one that's been making some moves.
Yeah, this call is really interesting. You've got this clear strategic repositioning happening, some big balance sheet changes, but then you look at the numbers, the immediate financials, and, well, they're facing some challenges. So we're going to unpack all of that.
Exactly. We'll look at the numbers, what management is actually saying about their strategy, and then tie it back to the bigger picture in the insurance tech world. Our goal is simple. Give you the shortcut to understanding what happened, why it matters, and what it might mean going forward. Let's jump in.
Let's start with the headline numbers. Reliance Global Group's Q2 2025. It was definitely a quarter with some big strategic plays, but also those wider financial losses. That's the key takeaway up front. The GAAP net loss came in at $2.71 million. And you need to compare that to last year, same quarter, when it was a $1.49 million loss. So it widened.
Oh, okay.
And it's the same story with adjusted EBITDA loss. That also widened. It went from about $0.18 million loss last year to $0.38 million this quarter. For a smaller company like RELI, widening losses like that, even if there are reasons, tend to grab attention.
Right. The market notices. And what about revenue?
Commission income was down just a bit, $3.1 million versus $3.2 million last year. But there was a bright spot. Their property and casualty P&C revenue actually grew. It was up 8% year over year.
Okay, so some growth within the top line number.
Exactly. So this first look, it kind of sets the scene, doesn't it? You've got strategic moves happening, things management wants you to focus on. But the immediate numbers, the financials themselves, show some real headwinds this quarter. It's that classic balancing act, investing for the future versus today's bottom line.
Okay, let's definitely unpack that. Let's get into the nitty-gritty. Beyond those headlines, what was really driving these financials, especially on the cost side, given those losses widened?
Yeah, and this is where it gets interesting because the higher expenses are kind of tangled up with their strategy. So commission expense, right? That went up to $0.99 million from $0.89 million.
Okay.
But like we just said, P&C revenue was up 8%. So more revenue, naturally, means paying out more commissions. That part makes sense.
Right, tied to growth.
Then you look at salaries and wages,
Yeah.
climbed to $2.6 million from $2.0 million. A big chunk of that increase, though, was non-cash share-based compensation.
Okay. So not an immediate cash drain, but potentially dilutive down the road.
Precisely. It hits the net loss figure, but it's an accounting thing more than cash out the door right now. Management also mentioned efficiencies they expect from their OneFirm strategy.
Right, the consolidation effort.
Yeah, trying to bring all their acquired agencies onto one platform, streamline things, cut redundant costs. That's the goal anyway.
In G&A, general and administrative, that jumped too, right?
It did. $1.5 million from $1.0 million.
Yeah.
And they said that was mostly acquisition-related costs, both cash and non-cash.
So it sounds like costs were up, yes. But management's narrative is, a lot of it is investment non-cash stuff or related to acquisitions. And this OneFirm thing is meant to bring costs down later. Spend money to save money, potentially.
That's the story.
Yeah.
And it really flags that key question for anyone looking at this. How much of this cost increase is just, the ongoing cost of doing business versus these one-off or non-cash items? Figuring that out is crucial.
Definitely. Okay, let's pivot to those strategic actions. Ezra Bayan, the CEO, and Joel Marovitz, the CFO, they talked a lot about this. The sale of Fortman Insurance seems like a really big one. What was the impact, though?
Oh, huge. This was a major balance sheet cleanup. It happened in July, so right after Q2 ended. They sold the assets of Fortman Insurance for $5 million, cash.
Okay.
And they didn't just pocket it. They took those proceeds, added some restricted cash they freed up, and paid down about $5.6 million of long-term debt.
Wow.
Yeah, effectively cut their total debt by roughly 50%. That's a massive deleveraging for a company this size.
50% debt reduction. So what does that actually do for them? What's the tangible benefit?
It's pretty transformative for their flexibility. They expect it to cut their annual debt service payments by over $1.8 million.
$1.8 million a year.
That's a 61% reduction in those payments.
Yeah.
Think about that cash flow impact. That's money they can now use for growth or operations or whatever instead of just paying interest.
Right. Frees up capital significantly.
Hugely. Enhances cash flow, enhances financial flexibility. Plus, they expect to book about a $3 million gain on that sale in Q3. That'll help their equity position, too. It just makes the company look less risky.
Makes sense. Now, something else new and interesting on the tech side, RELI auto leasing. How did this fit into their intertech strategy?
Yeah, this is quite a clever move, launching in July as well. It basically lets their RELI exchange agency partners offer auto leasing options directly to clients. So the agent can connect the client with a lease, and the agent gets commission on the lease and on the insurance policy that goes with it.
Ah, double dip for the agent.
Exactly. Deepens the economics for the agent, makes things more convenient for the customer, kind of a one-stop shop idea. And the agents don't need to be experts in auto finance.
So it leverages their existing platform.
Right. It uses their B2B platform, RELI Exchange, and fits alongside their consumer portal, 5-Minute Insure.
For sure.
It's a way to expand in the auto space without, huge capital investment. Smart adjacency.
Okay. And what about that Spenner Associates acquisition that was talked about before? Any updates there?
Right. So the original deal, the stock exchange agreement they had, that was mutually terminated back in Q2. No penalties or anything.
Terminated, so it's off.
Well, RELI expensed the shares they had already issued for it. But management made it pretty clear on the call they're still interested in Spenner.
Oh.
Yeah. They're still actively talking, but they're looking at a different structure for the deal. Something that hopefully makes better financial sense and creates more shareholder value than the first plan.
So not dead, just evolving. Trying to get a better deal.
Seems like it. Show some discipline, maybe. Not just doing a deal for the sake of it.
Okay, interesting. So looking forward then, Q3 and beyond, what did management actually guide towards? What's the plan now?
They didn't give specific number targets like revenue or EPS ranges, but they definitely set expectations. They expect that roughly $3 million gain from the Fortman sale to hit the books in Q3. That's a positive.
Right.
And more strategically, they're pointing towards stronger cash flow because of that big debt reduction.
Yeah.
And they expect ongoing efficiencies as that OneFirm integration continues.
More feature rollouts, too.
Yeah, expect more features for RELI Exchange, enhancements to the client service center, things like that. The main message really is a shift. They've gone through this intense period of fixing the balance sheet, selling Fortman. Now the focus is shifting towards, let's call it, measured growth, focusing on higher margin business driven by their tech platforms.
So moving from restructuring to actually growing the tech side more deliberately, a pivot.
Definitely feels like a strategic pivot. And, to really grasp what RELI is doing, you have to look at the wider industry. The U.S. insurance distribution space is still really fragmented, lots of small agencies. That fragmentation creates opportunities for companies like RELI to consolidate, to buy up smaller players and build scale.
Right. So the OneFirm strategy, integrating acquisitions onto their tech platform like RELI Exchange, that fits right into that consolidation trend and the broader move towards tech and automation in insurance.
Exactly. It aligns perfectly. And you also have to consider the current climate for smaller tech companies, especially insurtechs.
Funding is tighter?
Much tighter. There's huge pressure for discipline, cost control, a clear path to profitability. So RELI's focus on cutting debt, on efficiency, that's not just a choice. It's kind of what the market demands right now for companies their size.
Makes sense. Survival and then growth.
But despite all that strategic logic, the market reaction to the Q2 results themselves was, well, pretty negative.
Yeah, you mentioned that. The stock dropped significantly.
It did, down 16.4% the day after the call. On heavy volume, too. That tells you something.
What does it tell you? What were investors likely focusing on?
It strongly suggests they were zeroed in on the negatives. The wider GAAP loss, the adjusted EBITDA loss, and maybe also the timing or optics of a recent financing they did in ATM, an at-the-market offering, priced to raise up to $6.75 million.
Ah, the potential dilution from selling more shares.
Exactly. While ATMs are efficient for raising cash, investors often see them as dilutive. So it seems the market weighed those immediate financial negatives and the potential dilution more heavily than the positive strategic steps like cutting debt or the new leasing service.
So near-term pain outweighed the long-term gain narrative, at least initially.
That's how it looks.
Yeah.
And the stock has really underperformed the broader insurance sector, like the CAI ETF and the overall market, the SPY, recently. That points to company-specific issues, not just market trends. So for RELI, regaining investor confidence, it's really going to come down to proof points. They need to stabilize revenue, show that OneFirm is actually improving margins, operating leverage, and crucially, avoid significant further dilution if possible. The market needs to see results now.
All right, let's shift gears slightly. This is the part where we put on our, let's say, imaginative hats. This segment is purely for informational and entertainment purposes. Definitely not financial advice. Please do your own research.
Okay, disclaimer noted. So given everything we've discussed, the big stock drop, the Q2 losses, but also that huge debt cut and the continued talks with Spencer, here's an outrageous but maybe plausible idea for someone with a very high tolerance for risk.
Intriguing. Lay it on us.
You could consider a contrarian long position, basically betting against the current negative sentiment.
Trying to catch that falling knife, as they say. What's the logic?
The thesis is a bet on a specific sequence of positive events that the market seems to be ignoring right now because it's so focused on the Q2 miss. You're looking for a kind of triple win. First, they successfully renegotiate that Spencer deal and structure it so it's highly accretive, adds to earnings per share right away. Big positive surprise.
Okay, catalyst one.
Second, they book that full $3 million gain from the Fortman sale in Q3, just like they expect. Boost the financials nicely.
Catalyst two.
And third, and this is the really critical one, you start seeing clear, tangible evidence in the next quarter or two that the OneFirm strategy is working, meaning improved operating leverage, better cash flow.
So proof the strategy is actually delivering.
Exactly. So yes, it's trying to buy a stock that's been hammered, very risky. But the idea is that if these specific fundamental things happen, things management is aiming for, the stock could see a significant re-rating from its current micro-cap levels.
High risk, potential high reward, betting on a turnaround driven by specific strategic execution. Only for the very risk-tolerant who think the market has overreacted.
That's the idea. A speculative bet on management delivering on these key strategic promises.
Got it. Okay, and that really wraps up our deep dive into Reliance Global Group's Q2 2025 earnings call. Quite a story unfolding there. We've seen a company clearly in a portfolio and balance sheet reset, as you called it, big debt reductions, strategic sales and shifts, but also grappling with those wider losses that clearly spooked investors in the short term.
Yeah, the strategic direction towards higher margin, tech-driven business seems clear. You see it with OneFirm, our LEI auto leasing. The big question now is execution. Can they turn these initiatives into stable growth and better profitability quickly enough to win back the market's confidence? That's what we'll be watching.
Absolutely. And just a reminder for everyone listening, the information we shared here is for educational purposes. It is not investment advice. Always do your own research and maybe talk to a financial professional.
And we hope you'll think about these insights. How do RELI's moves fit into the bigger picture of insurtech and insurance distribution that you see? What stands as you from their quarter? Always good to reflect.
Thanks for tuning in to The Deep Dive. We really appreciate you listening and look forward to bringing you more deep dives soon.